The global economy is weakening very quickly. That's backed up by a lot of metrics. Most recent data out of China indicates they're on the brink of a recession, if not in a recession, which is kind of shocking considering this was an economy that grew at 10% compound rate for about 30 years. Just add a little color, which is, yeah, there is an inflation dragon and you do have to slay it, and we will, I believe we will. But it's going to come at an extremely high cost. A few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year. Now I say, we're in a recession. I mean, it's not coming, we're in it. And there's data. I never make statements like that, Brian, without supporting it with the strongest dollar in 20 years. Good luck with that. I mean, nobody can afford our stuff and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all?
Okay. And so does that imply then, if we just sort of let the system take care of itself?
All those things are happening. That's hard data. And it's a very, very troubling sign, last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening, the recession is a cure for it. It's coming. I mean, the recession is coming. And Jay Powell said this. I mean, Jay Powell gave two speeches, August 26th at Jackson Hole and September 21st after a press conference, tore up a speech and wrote a new one, like literally the day before.
Yep.
It was 3 or 4 pages. It was really short. He used the word pain 3 times in one paragraph. I've been following Fed news for 45 years. I've never seen the word pain ever.
Right, that was pretty amazing.
3 times. But he said Fed is behind the curve. And then beyond all that, Adam, is the biggest, the real, 500-pound gorilla in the room, if you want to call it that, is there's a brewing global liquidity crisis, a global financial crisis that's different from a recession. It's financial panics and recessions are 2 different things. They can come separately. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. And my point is, I think the Fed could get inflation under control by doing nothing right now.
Right.
If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff and we're not buying anybody else's stuff. November 2021. Every headline you looked at, website, commentator, supply chain's breaking down. There's no, they couldn't get cream cheese to make cheesecakes. What's going on with diesel fuel? We're down to 25 days supply, probably going to run out around November 21st. I mean, run out. That will shut down the economy faster than COVID, pandemic, war, anything you can think of. And people go, well, normal supply is around 30, so what's the big deal if it's 25 days? The answer is you can't replace it. If we go from 30 to 25 days supply, we say, okay, fill up the tank, send me some more diesel, and on and on and on, like a long list. And then last spring was the baby formula shortage, which was serious. I mean, mothers couldn't feed their children. So it was very bad. And I talked to my editor about the book. We said, okay, let's do it. Because everyone says, well, yeah, COVID messed it up and the war in Ukraine messed it up. Well, that's true, but it didn't start there. This started in 2018 with Trump's tariffs, because I'm not here to debate the tariffs. I actually think the tariffs were a good idea, but that was the start of the supply chain breakdown. Because when Trump put tariffs on, started with appliances, washing machines, refrigerators and stuff, and then solar panels. But you have to look at what China did in response. The U.S. and Brazil are the 2 largest exporters to soybeans. China is the world's largest importer of soybeans. China was buying all their soybeans from the United States just as a way to kind of make it up a little bit. Like, well, we got to buy the soybeans anyway. Why not buy them from the U.S. to keep the U.S.-China trade deficit under control so it doesn't become too politically toxic? Well, as soon as Trump threw on the tariffs, China retaliated by moving their soybean orders to Brazil. Stop buying U.S. soybeans. Well, that's not a phone call. If you buy insurance on your house, or I buy insurance on my house, you don't want your house to burn down. You hope it doesn't. But if it does, you don't think your insurance premiums are a waste of money. Like when you write that check, you're like, that's money well spent. When you pay higher prices for consumer goods, the delta between the old price and the new price is your insurance premium for a more reliable system. And also, there's a big national security component to this. And I talk about Russia and Ukraine and China in the book. But then my editor, who's love working with us, she said, well, Jim, got to be a chapter on inflation. I said, of course we do. The supply chain breakdown is causing a lot of the inflation we see. And we agreed on that. And then I said, I'm going to write another chapter on deflation. If you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So I do, that is my view, but it's shared by a number of other analysts. So people extrapolate that. And again, there is this comparison to the 70s. By the way, I think the situation we're in today is very different from the 1970s, and I'll explain why. But, I'll explain why right now, because in the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war. And then the price tripled, but it went from like $2 to $6. Okay. But in percentage terms, that's a huge jump, but it was still $6. And then it got to 12, and demand is inelastic, so you just pay up or, kind of do without. But the demand side is much more psychological. That's called demand pull inflation. The Germans are out chopping down trees to get wood to stay warm this winter. There is no firewood for sale. This isn't medieval, this is Neolithic. And then, the Poles are lined up to get coal depots to get some coal in the trunks of their cars or the flatbeds of their pickup trucks for the same reason. So this is a disaster. Now, over the United States, that's not sustainable. So I would look for a recession, a more severe recession. We do not have demand pull inflation. We don't. This is not what's going on. We do have cost push inflation. The difference is hugely important, because cost push inflation from the supply side, which is, again, when I talk about in the book, it's real, prices go up, but it's self-negating. The old saying that, the cure for higher oil prices is higher oil prices, because when they get too high, people stop driving. They shut down various activities. By the way, if you're unemployed, you're not buying any gasoline because you're not going anywhere. I mean, that's kind of a nasty way of putting it, but that's how cost push inflation for a lot of reasons. But right now we don't have demand pull, we have cost push. It will go away when this economy goes into recession. And then we're going to be talking about disinflation and deflation, which are, kind of close cousins. And the Fed's going to be out on a limb as usual, raising rates in the face of a recession and a price collapse. They can come together. It looks like they might be coming together again. This is revealed in inverted yield curves, government expenditure, like a 4-part thing. Yeah, but there's a simpler way to do it, which is how many people are working, how productive are they? Who's working and how productive are they? That equals nominal GDP. And if you have fewer people working, the economy is going to shrink unless productivity is going up, which it's not. And so this is one of the major headwinds. Now, you're right, there are some early retirees. Working is a habit, it's a good habit, I think, for the most part, but it's like any habit. Once you break it, it's hard to go back. So once you get used to not working, or working from home, or, we're just staying home. And people call this a labor shortage. There isn't actually a labor shortage, because we just talked about how you've got perhaps as many as 10 million, people between the ages of 25, 54 who are sitting home. But the problem from the employer's point of view, there's a shortage of willing workers.
Willing workers, yeah.
Not workers, but willing workers. Well, what makes you willing to work? Well, a raise, a good pay is one. As employers can't afford to pay the clearing wage to get people off the couch, because they'll go bankrupt themselves. They're working on very small margins, sales are declining, et cetera. So I'll pay as much as I can to get the workers, but it's not enough to get this person off the couch, so to speak. And so you've got this really weird situation. I use weird in the technical sense, where you have a huge pool of able-bodied, potential workers, but a shortage of willing workers because you can't pay a clearing wage. But that's more a reflection of how stressed businesses and how low margins are. And then you look at the big names. I mean, I guess Twitter is the most recent, but Amazon, FedEx, Target, they're all looking at big layoffs, and
Big layoffs,
big layoff announcements coming every day. So, but none of which is good for the U.S. economy. But the Fed looks at unemployment. Well, the fact is, people don't understand diversification. I run into people all the time. They say, well, I'm fully diversified. I've got 50 stocks in 10 different sectors, semiconductors, consumer non-durables, mining and minerals, et cetera. And I say, you're not diversified. You may have 50 stocks, but you have one asset class. It's called stocks. And they're all going to go down together or up together, as the case may be. Real diversification, have a slice of stocks. I'm not anti-stocks. Have a significant slice of cash, which is a low return, but in deflation, it could be your best performing asset in real terms. But it also gives you huge optionality. When everything else collapses, you can be the one who goes shopping for the bargains. And by the way, Berkshire Hathaway, Warren Buffett have $130 billion in cash. They see what I see, and they're ready.
But I'm guessing with the deflation you see ahead, you see better bargains ahead here.
Yeah, because the stock market's going to crash. I mean, just take everything we're saying. Recession, higher unemployment, lower margins, supply chain disruption, et cetera, energy disruptions, shutting down. That's going to destroy corporate profits. That's in the cards. It doesn't mean the end of the world. It means you go shopping and pick up some bargains, but not yet. Slice of gold, I recommend 10%, not 50. People love to put words in your mouth. Jim Rickards says, sell everything and buy gold. I've never said that. I don't believe that. But I think a 10% slice is right. This room, if you want to pick stocks, I like the oil majors. They're, forget Greta and forget Julian Tett, my friend of the Financial Times, who's a climate alarmist. Forget all that stuff. We're not getting away from oil and natural gas for decades, if not longer. Those stocks have been beaten down. BP, Chevron, ExxonMobil look really good. There's room for private equity, some, venture, tech startups, real estate, not commercial, but residential, farms.
But all of a sudden, bond yields are beginning to look pretty attractive in certain cases. What do you think?
I love, yeah, you're right. I love 10-year Treasury notes, and if they're a little too volatile for your taste, 2-year Treasury notes will do just fine. But yeah, rates are going to come down, and when rates are this low, there's something called the DV01, dollar value of 1 basis point. In other words, for a given amount of rate reduction, the capital gain is greater when rates are lower. It's just bond math. So at these levels, you can see some very good capital gains. And that's a diversified portfolio. So if you've got gold over here, stocks over here, cash, real estate, private equity, natural resources in the middle, that's diversified.